Make sure you hit record. All right, good evening. Thank you everyone for joining us for our live webinar tonight. Over the next 30 to 45 minutes, we're going to be walking you through how, as an incorporated professional or business owner, you can take advantage of strategies to get money out of your corporation more tax efficiently, or even in some cases, in certain situations, potentially even tax-free. Now, for those of you who don't know me, my name is Grant White, and I'm a portfolio manager with Endeavor Wealth Management. And for tonight's webinar, I've brought on Aaron Sabash to join me. Now, Aaron is one of our insurance, tax, and estate specialists at Endeavor, and I've asked him to walk us through a few strategies which we've been utilizing, especially more recently with a number of our clients, which can help you to significantly reduce your tax rate, and in addition to helping you accomplish your goals more efficiently. Now, before I pass things over to Aaron, I just wanted to touch briefly on why we're talking about this subject. More and more, what we're seeing in the financial services industry is a lack of cohesion between the advice being delivered to people with corporations. Now, this is leading many people to paying far more tax and paying far more for services than ultimately is needed. Now, this is especially important after the tax changes that we've seen come into place in the last few years, and related mostly to the passive income rules which have changed in corporations. Now, maybe more importantly than that even to consider is the potential tax changes that could come in the wake of pandemic deficits, which in Canada have run over $350 billion, which are, if anybody's keeping track of that, that's levels that we haven't seen since World War II. It is my belief that what is needed going forward is a complete ecosystem for advice, which works together cohesively. Now, to explain what I mean by that, I like to use Apple as a good example of this, because if you think about what makes Apple so special as a company in creating great experiences and value for their customers, it's their ecosystem. Sure, they make great products with excellent functionality and designed really well, but it's the ecosystem of devices and services which really adds power and really adds value to you. And it's the fact that you can access all of your photos, music, video from every device you own through the cloud with ease, or the fact that if your Apple Watch says you've taken 10,005 steps today, that your iPhone says the exact same thing. The consistency of experience and the cohesiveness of everything working together is what makes Apple customers' lives that much better. Now, it's my belief and our belief here at Endeavor overall that this is what is going to be needed going forward with your wealth management needs. And that's what we're doing here. So with that, I'm going to pass things over to Aaron to walk us through more of the specifics of the strategies that you're all here to see more about.
Okay, thank you, Grant. So before we actually get into talking about certain strategies and what tools we have at our disposal, what we want to do is we want to kind of set a foundation and set a basis here. Why do we talk about tax and why do we believe it's important when we work with Endeavor and support their clientele? So, as a firm, what we believe is there's really two things that kill wealth. And this is not only our belief, but through our experiences, we've seen this, day to day, month to month with our clientele. So number one is a medical emergency, right? So someone's ability to earn an income if they've lost that, or maybe more pertinent to tonight's presentation is, if you can't operate your business, revenues stop, income has stopped. Obviously, your ability to amass wealth and grow wealth is now inhibited, but also maybe some wealth you've amassed now has to be drawn down so you can support yourself. So we always want to cover off medical emergencies, but the second thing is taxation. Taxation kills wealth. And I always like to ask clients when we sit down, I say, what is your biggest expense of your life? And, typically people will say, oh, it's my mortgage or it's my commercial mortgage. And that's a good guess. But when we really get down to the numbers, it's taxation. It's the biggest expense of their life. And when we're talking on those two topics of a medical event or taxation, people get sick. It happens. It's more common than we think. But not everyone gets sick, whereas everyone has to deal with taxation, whether it's during their working lives or into retirement. We look at the assets we own, everything is taxed. So that's why we like to, address that. And when we move to the current taxation environment, as Grant kind of outlined, come January 2019, these new tax measures came in with private corporations. Many people like to refer to them as the more no measures, after our finance minister. And there's a few changes with the, TOSI rules, tax on split income, or like Grant alluded to, the passive income changes. But they can be quite punitive. And I know there's certain scenarios in certain provinces where we've even seen, tax rates over 100% on the corporate level in very specific scenarios. So something to certainly be cognizant about. And the other thing we like to just address at this time, because we've had this unprecedented 6 months of events, is fiscal spending. The government needed to get money into consumers' pockets, into business owners' pockets, and I think for the most part that's worked well. But as we saw the budget deficit yesterday, and the deficit in general, reaching $1 trillion this year and next, someone's going to have to pay for this. And we already pay pretty high tax rates in Canada, but it's possible they could go higher. And we like to talk about World War II, when the highest marginal tax rate was 95%. Now, hopefully we don't see that. I think that's unlikely. But if we say, is it possible that tax rates could go up? I think it is very possible. So if we move to the next slide, the last reason why we really like to focus on taxation is because of its predictability. So when we talk about different asset classes, we don't know what they're going to do in the next, year, 3 years, 5 years. Taxation, we can build in guarantees. We know what the tax tables say. We know what a deduction is going to create back in a refund. And so we love building in predictability and guaranteed returns into plans using tax savings. And the last thing that we found with our relationship, with Endeavor and Grant and the team here, is that when you mix great financial planning, portfolio management, and great tax planning with ourselves and your own tax professionals, there really is no equal, and the outcome from the client is the most positive and the best. So with that in mind, setting the stage, that's kind of our ideology, how we look at things. We're going to get into a few examples. And, first we're going to look at a private health spending plan. We want this first example to be really tangible to everyone, right? Everyone's got different issues with their corporation, but this is generally a strategy that's going to work for most people and save them, significant amount of tax. So if we move to the next slide, what is a private health spending plan? So we're using corporate pre-tax dollars to pay for our healthcare expenses. It's much more flexible than an employee benefits plan where we're paying premiums every month and we have co-pays. We're literally writing off our personal medical expenses through our own corporation. Those can be traditional expenses like dental, and also a wide list of things like CAT scans, MRIs, and even fertility treatments. And so, to take a look at how this actually works in action, we'll move to a quick example that Grant and I have come across. Thank you. And so basically, we've had a client in the last year who, was a 7-figure earner, like high marginal tax rate, right? Half of every dollar she earns, more than half is going to the government. She was also having fertility treatments done, and she was paying out of pocket. So, she would have to earn $30,000 of T4 income, or, take a non-eligible dividend of $28,000 to pay for that $15,000 fertility treatment. You got to earn a lot of money just to pay for that out of pocket. What we're able to do with this private health spending plan is very simple. We take that expense and we put it in the accounting of the company and show it as a write-off through this private health spending plan. So what we did here is we took that $15,000, we wrote it off corporately, and the way that this PHSP was structured, there was a 10% admin fee on all expenses. So there's another $1,500, an additional write-off, but that business only had to earn $16,500 of income to pay for that expense, as opposed to 30 grand out of pocket. So you add that up between 2, 3, and 4 kids, we've just saved tens and tens of thousands of dollars of money. Now, not everyone's spending $15,000 a year on medical expenses, but you can think if you're in a high marginal tax bracket, even $2,000, $3,000, $4,000 makes sense to implement this simple strategy and write those medical expenses off. So that's the example for everyone. We're going to move into a few more here that have a more specific flavor to them. So first and foremost, split dollar critical illness. If we move to the next slide, why we like this product and this strategy is because, as we talked about in the first slide, what kills taxation? Well, medical emergencies and taxation, right? Sorry, what kills wealth? And so with this, what we're able to do is we're able to protect that business and its continuity through a critical illness insurance policy. So if that business owner or shareholder gets sick, they're diagnosed with a covered condition, that business is going to get a big tax-free injection of cash. They can hire a replacement. When in business, cash buys us time. And so we always want to cover this off for clients. And heart attack, stroke, cancer are going to be 86% of claims. Now, I know personally I paid 3 claims in the last 2 years. The youngest was a 32-year-old and the oldest was a 45-year-old. So when I walk through the door with that tax-free money, well, guess what? You make a big difference in someone's life and you save their business at the same time. So we like that for number one, protecting against that medical emergency. The other thing we're able to do if we don't actually claim is we can take that money back to ourselves personally, the shareholder. So we're going to set up an example on the next slide here for everyone. We have a business owner, age 45, he's a male, and over the next 20 years until age 65, him and Grant have sat down, they built a financial plan. He knows he's going to pull the plug at 65. But for those next 20 years, they want to protect his business, against one of these medical emergencies with a tax incentive as well. So we determined, he needs $200,000 of critical illness coverage. And it's going to cost him $6,100 a year. So if we move to the next slide, we see how this is broken up. The only thing I want you to take from this is know that 71% of that premium is paid with corporately taxed dollars at a very low rate. Now the small business rate in Manitoba is 9%. So those are very efficient dollars. And the other 29% is paid personally at the client's marginal tax rate. But the majority of that $6,100 a year is paid with corporately taxed dollars. And if we move to the next slide, we'll see how that actually works out. So at age 65, client hasn't claimed their critical illness benefit. They haven't gotten sick. Everyone's happy. They elect to take that money back and they get it in their own personal bank account of that shareholder. So again, you get $123,000 back, remembering that the majority of that money has been paid with low corporately taxed dollars. So we can protect the business, we can build in the tax strategy at the same time, and we're a huge proponent of this. We really like this for a lot of our clients, and particularly our kind of younger professional clientele. So with that in mind, we have one more example for you today. Corporately owned life insurance. Now the breadth and width of what we could talk about, we could probably talk for days about the possibilities behind this, but again, we just want to give you an idea about the possibilities. And there's 4 laws which we use when it comes to life insurance that are in the Tax Act. So number 1 is tax exempt. When you deposit money, you do a life insurance policy. As long as it stays on side with CRA, the money grows tax exempt in a tax sheltered environment. Number 2, tax-free. When someone dies in Canada, the death benefit pays out tax-free to their beneficiaries. Number 3, that policy is corporately owned and that individual dies, that shareholder. The death benefit credits the capital dividend account, which is a notional account that pays a tax-free dividend to another shareholder or the deceased shareholder's estate. And if we design these properly by life expectancy, we'd expect the whole death benefit to credit the CDA. And the 4th law we talk about is collateral. So the Tax Act says in Canada, you can take a corporate asset and collateralize it against a personal loan. So let's look at a few ways that we use life insurance in a corporate setting. Funding liabilities like debt, estate equalization, charitable gifting. This is a huge one Grant and I talk about often with clientele. We want to make a difference in a charity's life as well as your family's life. Post-mortem planning, where's that business going? Where are these assets going? Insurance trusts, leveraging, and shareholders agreements. And if we go to the next slide, we're going to look at an actual example here to, again, try to quantify this for you. So, we had a client recently, Grant and I, and they had a bunch of extra corporate surplus, right? They have money they don't need. So they're kind of sitting here and they're saying, I made all this money, I amassed all this money, and now it's just kind of a tax liability to me. I don't need it to fund my retirement. It's just kind of this big tax bill when I pass away. Like maybe I should have made all this money. This is a problem. And we like to come in and say, okay, well, we like to solve problems. So let's solve this problem for you. And these clients were really interested in giving a charitable gift. So another conversation we have is when you pass away, there's three places your money can go. It can go to your family, it can go to the Canada Revenue Agency, or it can go to a registered charity. And you can pick two of them generally. And clients can really get behind that idea of going, hey, listen, obviously I want my family to get money. I want, my kids and grandkids to get an inheritance, but if I can redirect assets towards a charity that I'm involved in, that I believe in, boots on the ground, I'd way rather give that money to them than just pay a tax bill. So we can structure that. So if we move to this last slide here, we're just going to show you a simple example of how we use this corporately held life insurance to build a lot of efficiency into a plan. It's got $1 million of corporate surplus that we don't need for retirement. It's trapped. They die tomorrow. They're going to have to pay, $460,000 of tax at least, if not more. It's just a big tax problem stuck in a corporation. So we say, listen, Mr. and Mrs. Client, let's reposition this $1 million into a corporately held life insurance policy. What would that look like? So life expectancy, if we have, two individuals age 55, life expectancy age 85, they were both to pass away, leave $5.2 million after tax to their estate. Pretty good outcome. We've 5 times that money. And the question becomes, okay, well, what are the other options? Well, even if you had invested that money in your corporation, getting 6% at a growth allocation where we have, capital gains and dividends more preferentially taxed, still at age 85, only going to get 2.76 million after tax. So we let you decide, what's a better outcome for you? Do you get to give the gift you want and more to your kids, or do you want to just pay more tax? And the last thing I'll note here is when we deposit this money into these policies, a lot of times people think, okay, well, there's that $1 million, it's gone, it'll pay out when I pass away, but for now it's gone. And that's not really the reality, because as the cash builds in these policies, we remember the fourth law of collateral. We do have the ability to access this cash if we want to. If we get into a financial emergency and we need to access some of it, or if we just want to supplement maybe some costs in retirement, we can take a personal loan collateralized against this policy and access some of that cash. So we're going to move to one more slide. This is just scratching the surface of, what we have in our toolbox. We wanted to keep things simple, just get the ideas flowing. What we always like to say is, don't disqualify yourself. Let us be the experts. Let us be the professionals. Let us qualify you. You have tax problems. We're going to be a difference in your life. If you think you're paying too much tax, we're going to be a difference in your life. And I'm going to finish with 2 things. And first is an analogy that I like to share, particularly with business owners. So, if anyone knows anything about cars always have limiters on them, right? So, okay, well, I have a sports car that can go 200 miles an hour, but it's limited to 150 miles per hour, right? There's a limiter. Doesn't matter, you can go farther, you can go faster. You're going to hit that limiter. And in our experience in Canada, taxation for business owners is that limiter. So we like to take that limiter off of people's lives. And what we found is when you do that and when you mitigate taxation, the business you build is beyond your wildest dreams, and the abundance you build for your family and the causes you care about is beyond what you could have ever imagined. So, let us take that limiter off of your life and your business. And the last thing I'm going to say is, through our process when we work with Endeavor, it's really important to know that we always build consensus with your professional advisors, your tax accountant, your tax lawyer. These are the trusted relationships that have been in your life for years and years. We're not trying to bypass them. We're not trying to reposition them. In fact, we believe that to build the best plan, we need to work alongside them and build consensus on these strategies. So, just know that they're going to be involved in the process every step of the way.
Thanks, Aaron. I really appreciate that. And so, as Aaron was mentioning, and maybe Aaron, I'll get you to turn down your volume a little bit there, but there we go. So as Aaron was mentioning, of critical importance in all or any of these strategies, it's really evaluating what is most suitable for you individually, for your family, and of course for your business as well. And so to make sure that we provide the best advice that is suitable for you, we utilize a process that we call our smart money planning. Now, what we do is we start by doing a deep dive discovery with everyone we work with. And this is really the most important step as we find out what and who are truly important to you. We hear you tell us about your goals, your dreams for the future, and how you would like to live your life, and gather the details that we need to help you make things a reality. Now, from there, we collaborate with both our internal specialists like Aaron, as well as your existing trusted advisors, including your accountant, as Aaron was mentioning, your lawyer, or anyone else really that might be of importance to you in providing that solid advice that you've relied on in the past. Now, with their help, we develop a strategy specific to your individual circumstances, customized to you. And ultimately, through consistent and regular communications, we build a long-term relationship with clients so that we can adapt to your plans, to your changing lifestyle, and also plan for external factors that are out of your control. I mean, we've seen a lot of those external factors come up in the last year, whether through the pandemic, where we've seen tax changes in the last few years, and as Aaron was pointing out, who knows what the future holds as it relates to other tax changes that might come into play. Now, the ecosystem, as I was mentioning earlier, is developed by collaborating with our own internal specialists, ranging from our internal people, including financial planners, portfolio managers, estate and tax specialists like Aaron, and also working directly with your trusted advisors, which again includes your accountant and lawyer, and in most cases, potentially, or in many cases, potentially others as is needed. Now, the real power in all of this is that all of these different people are working cohesively together. And you'll go back to that Apple example where everything needs to be succinct, working together, and that really makes your life, that much easier, but also adds so much more value to you and in your planning work. And then ultimately the goal is that we want to make sure that you're receiving the max value out of everything. So, I'll just close things off by saying that there's a lot of different things we can do in these areas. As Aaron was pointing out, we scraped the high level on these and on purpose, because everything depends on everybody's individual situation. And so, as Aaron said, don't disqualify yourself by thinking something can't be done. What we really want to do is take a look at everybody's individual situation and allow us to go and do the deep dive to make sure that we're maximizing out everybody's value, making sure that you're not paying any more taxes than ultimately you have to, and making sure you're keeping assets going to where you want them to go, whether it's your own personal lifestyle or your family members, or even charities that are important to you. So if you do have any questions on any of these topics, or if you'd like to take a deep dive into your own situation, we invite you to please reach out to us. We feel free to go to our website at endeavorwealth.ca. Feel free to email us directly, or to the general mailbox at info@endeavorwealth.ca, or by all means give us a shout at the number on the screen here. So thank you very much for joining us this evening. We wanted to keep it brief, because we know how valuable the summertime is to everybody and their time. But we hope that we'll be speaking with you soon. And again, if any questions, please feel free to reach out to us. Thanks so much. Have a great evening.